Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at RB Global, ticker RBA. This is a requested stock, and it's probably going to be a bit of a quicker one because I just don't like a lot of the things that I'm seeing on it. So we're coming up with a fair value around $77 with an actual value of 78 and discounted cash flows of about 94. So cash flows are on average pretty strong, almost 14%. This last year they weren't too good, and that's one of my big issues with this company is just the inconsistencies. We see hop up from 2020 to 2021 and then dip back down in 2022 and then came back in 2023. And we'd like to see some just consistent growth, even if it's small, but these ups and downs are just, they make it hard to forecast, and just aren't a good sign for a company. Earnings yield, pretty low. We'd like to see them come in with $3.91. And again, we're going to talk about the inconsistencies here because this year analysts are expecting 329, next year 365. So they'll probably hit that target in the next 3 years. But last year they came in at 186, 105 in 2022, but $3 back in 2021. So a lot of up and down all over the place here. Cash flow yield, 8.2%, usually around 13.9. We've touched on how inconsistent that is. Dividend yield, 1.4, usually 1.7. Payout ratio is creeping a little high. We like to see that under 50%. 30 to 50 is ideal. 58, it's getting a little high. I wouldn't expect them to really raise the dividend a whole lot. ROE looks decent, 6.1%, but the debt to equity is high at 1.4. We want to see that under 1. ROI 5.5, that's okay. And ROA 2.5, that's really low. So they're not getting a whole lot of return on those assets. Margins came in low this year, 47.5 gross, usually around 52. And then on the net side, 7.25, usually around 10.3. So the thesis becomes a little difficult with all these inconsistencies. Analysts on the higher end are projecting somewhere in the realm of 2% growth, which, I mean, anything less than that, it's not even really worth considering. So we're going to go with 2% for this revenue growth on our thesis. Share count, they issued a lot of shares in 2022. Usually they hold flat, maybe raise it a little bit. So we're going to go with 1%. We'd really like to see them buying it back, but I'm not seeing that kind of move from this company at this time. Cash flows, if they can get that 3-year average of 8%, that'd be good. But with 2% revenue growth, I don't know about that. Assets, they are all over the place on the balance sheet front. I mean, you can see these massive numbers here, but if I put something massive in there, then it'll inflate the returns significantly. So we're just looking for something more reasonable that we see from a normal company with assets outpaying liabilities as they've done, at least in the last 2 years. So 5 and 4. Dividend front, actually, I think that is going to continue to slow down. So 3.5 rather than that 4. And then margins, they do have the ability to get back up to what they've seen historically. So even this 2% would only take them up to 8 in 5 years. So if we do 5%, that takes them up to 9. I'd like to see this get back above 10 in the next 5 years. So That'd be 7% annual growth in those margins. And that would amount to a pretty small 5% annual growth in the fair value. And once you factor in dividends, 6.4%. So a reasonable scenario here, you're not getting returns in line with markets. The stock might currently be sitting a little elevated above the fair value, but when you're missing out on 3 to 5% per year, it adds up, and you're underperforming the market by about 19% over the 3-year and almost 30% in 5 years. So not something that I would really entertain. It's not a value stock. It's not a growth stock. I don't know necessarily what kind of bucket I would put it in, but we don't really need to do a worst case scenario because this scenario here is already a bad case. If we do an ideal scenario, let's see, 15% in the last year for revenue growth. Share count holds flat. Cash flows, again, we're trying to be kind of reasonable with this. I don't want to put in 50%. So we'll just keep it not in line with the revenues because we got some room for getting our yield back. So we'll go with 18, slightly outpacing those revenues. Assets, again, I don't want to go with a crazy number that's going to inflate things. So maybe 10 and 8. Dividend 4.5. And margins 10. It's taking them not only back to what we've seen previously, but above that. And now it's a better situation, 13.3% annual growth in the fair value. And we're looking at about 15 after you factor in the dividends. But again, this is not a reasonable case. This is the best case out of every metric that we see here. So when we look at the price graphed out, we see the balance sheet is making a comeback. I mean, with that massive growth that we saw in this last year. So it definitely looks like they issued some shares and were able to convert that into assets, which could help them in the future. We'll have to see how that plays out. But their current return on assets is not very good. Cash flows are lagging behind by quite a bit. And the fair value is right here. The only it looks like back in 2022 there was a lot within this specific area for the valuation. It looked like the value was truly obviously around $30, and yet the shares were trading for about 60. But when we look at the actual share price, the market seems to trade at a premium consistently. Even where it's currently sitting right now is just above the share price. That's what we saw this last year. A big gap back in 2022, very close back in 2021, and a medium-sized gap back in 2020. So again, I don't feel like there's much to say on this one. It looks like if we get a scenario where analysts are expecting and kind of in line with what we've seen over the past few years, you're not going to see any incredible market beating returns, and it's not at a great undervalued price at the moment. Even being slightly elevated above the fair value, you're underperforming the market by 1% in the 3 years. So essentially in line with the market in I don't think I want to say that. Now we may be able to revisit this down the road. Based on their averages, cash flow yield looks good. Dividend yield has pulled back a bit, but that's not an amazing dividend. I don't think you're ever going to get an incredible dividend out of this one, 2% at best. Margins, 52% is pretty good. They pulled back 10% of their average margins. And on the net side, they must have had a lot of expenses because they pulled back, well, it'd be 30% of their average margins. And if they can get those back in line, that'll fix the cash flows, help them shore up the balance sheet, and be able to invest and drive the company forward. But on a decline like this, I don't want to catch a falling knife. So I would just wait and reevaluate, and that'd be probably the best thing to do here. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.